Hi, my name is Dean Scarpinato, and I am a mortgage loan originator specializing in reverse mortgages. I am fortunate to work closely with a very experienced and conscientious estate planning attorney. Our mission is to help your estate to grow while freeing up capital for living expenses today. Please allow me to briefly explain. A reverse mortgage is the common name for a HECM, or home equity conversion mortgage. As the name suggests, a HECM allows you to use the equity in your home while still living there and maintaining ownership. For instance, if you're a senior citizen, 62 years of age or older, you may qualify for an FHA-insured home equity conversion mortgage. Why? Well, many wealthy folks and many folks who aren't so wealthy but are motivated toward perhaps increasing the family dynasty understand the value of estate planning. In any investment strategy, the use of cash that is just sitting there, also known as dead money, to place in an investment vehicle with greater return is as basic as ABC. HECMs, or reverse mortgages, are a great method for freeing up substantial sums which can then be reinvested. Insurance products, for instance, can instantly multiply your estate, and a long-term care policy combined with a reverse mortgage can guarantee you that you may be able to stay in your home for the rest of your life and that the costs of home care are covered. HECMs are used for estate planning. That is, with the help of an estate planning attorney, you may find that your money can be better utilized than just sitting in the equity in your home. Equity is like a large piggy bank that you are not free to spend. It can make you wealthy on paper, but lacking in actual cash flow. Estate planners often use HECMs or reverse mortgages to free up that cash and put it to better use. You may actually be able to increase the value of your estate and stretch your available cash in retirement. And this is not just available to the very wealthy. HECMs or reverse mortgages are also used to save homes from foreclosure or tax deed cases. Unlike most other mortgages, our clients have qualified for these loans with limited income and credit while they were in foreclosure, bankruptcy, or a tax deed case. Say that you or someone you know has a lot of equity in their home. Maybe it's even paid off, but they have not been able to meet the property tax or insurance requirements for a couple or few years. They are in serious danger of losing their home, and with it, every cent of the equity that they have accrued over the years. With a reverse mortgage, they can literally use their home to keep their home. With enough equity, delinquent taxes will be paid and funds will be set aside to cover future tax obligations. And as long as you, the borrower, lives in the home and keeps current with taxes and insurance obligations, you will never need to make a mortgage payment of principal and interest. If you qualify, a HECM could provide you with the funds needed to pay your taxes due now, to pay future real estate taxes and homeowners insurance for the rest of your expected lifetime, and provide you with additional cash flow. Reverse mortgages are also a very wise vehicle to allow you to put off your Social Security withdrawals until age 70. In so doing, you can increase the actual amount of Social Security payments dramatically. Taking Social Security benefits before you reach full retirement age may not be in your best interest. There are penalties for beginning Social Security too early and credits for waiting. If you can postpone Social Security until age 70 instead of age 62, you can receive as much as 70% more. But what do you live on until then? Well, if you have a good estate planner or are financially astute yourself, you will undoubtedly consider a reverse mortgage. In the same vein, HECMs provide an alternative to drawing down your retirement and stock portfolios. Many folks rely on the 5% rule. That is, they sell 5% of their stocks per year to live on in retirement. That's great when the market is up. It can be a disaster when the market takes a downturn. Selling low is no one's financial strategy, yet it can be necessary if you're counting on your stock portfolio to subsist. A reverse mortgage with an ever-increasing line of credit is the perfect reserve fund. Like a credit card, interest is only accrued when you access the funds. Unlike a credit card or traditional forward mortgage, you are never required to make a mortgage payment as long as you live in the home, maintain the premises, and pay the taxes and insurance. In some cases, based upon borrowing habits, the length of a borrower's life, and/or the rise or decline in the value of the home, a borrower may actually owe more than the value of the home when he or she sells it, moves out, or passes away. That does not matter. The price the home brings on the market satisfies the obligation, period. Let me explain just a little more. Say a borrower owes $120,000 on a property that's worth $100,000. And let's say he wishes to sell the property, but the market is down and they only get $80,000. That $80,000 satisfies the obligation to the lender. In most forward mortgages, the bank could actually go after the borrower for the difference. This is known as a deficiency judgment. Not so with the reverse mortgage. It is a non-recourse loan. We're just getting started, and I know it might seem overwhelming. That is why HUD mandates that before applying for a reverse mortgage, a borrower attends counseling. They are there to teach you the basics and explain terms, requirements, limits, the pros and cons, and more. This is done in an objective manner with no sales pressure. The FHA HUD counselor is not a salesperson. Their job is to explain the product to you, to give you a good understanding of what is being proposed. Only when this completed counseling is HUD certified, attesting to the borrower's understanding of the costs and benefits, the process and requirements, and the terms and conditions, are we legally allowed to proceed. And if you're working with me, before you get to that point, you will have received a free, no obligation quote and consultation. You will already know how much money you can free up and what the associated costs will be. It differs based on the age of the youngest borrower, the value of your home, and the expected interest rate. It will also differ based on the specific product that you choose that best meets your needs and your goals. By the time you actually sign the application, you should be quite confident that you are making the right decision. And even then, there is no obligation. You can cancel at any time until the loan is funded. So if more questions arise during the processing, or if unexpected circumstances change the terms or conditions, or your needs and desires change, you are still under no obligation. Call or email me for a quote. Doesn't it make sense to know your options and to be more informed about your financial possibilities? If you answer no to this, well, maybe I can't help you. But if you answer in the affirmative, you may find a new door open that can utilize the hard-earned equity in your home to remain in your home and not only meet the challenges unique to senior living, but in many cases to thrive and to pass on the American dream to your children. Your home often represents your largest asset. It can be the key to stability and security, and/or it can provide a greater estate for your heirs. The key is in the planning. Your first step? Email me at scarpinati@aol.com. In the subject line, type Heckham quote. I'll be in touch right away to get the ball rolling on what could well turn into a lifetime alliance. Thank you for listening. I wish you all the best. Thanks again.